Anthony Sebale, and I'm your host for Financial Markets, where we talk the money and capital markets, especially those of Uganda here, helping you actually understand what is involved in the sector, in the banking sector, in the capital markets, the regulators, the players, the key people who are actually influencing the financial markets of the country as Uganda. Now today, in a very special way, we have a resource person from the Capital Markets Authority, and we are here to hold a conversation on what capital markets are and how you at home can actually start getting involved, and why it is important as well for you to start getting involved in the capital markets of Uganda. His name is Mr. Owini Martin, and he's here and is going to give us a lot of insights into some of the things that you've been asking yourself about capital markets. Mr. Owini, you're very welcome.
Thank you, Anthony.
Yes.
Yeah, pleasure to be here.
Let's start with a little bit of breaking down financial markets as a big thing.
Yes.
We understand there are two kinds of financial markets, the money market
Yes.
and the capital market. Could you draw a line for our viewers on that distinction between the two?
Excellent. Thank you, Anthony. In explaining the capital markets, let's look at the full financial industry. So when it comes to the financial industry in Uganda, the first thing people understand is commercial banks. Because at the end of the day, whether you're talking Stanbic or you're talking Centenary, Equity, Standard Chartered or ABSA, you just need to walk in and open an account and transact on that account. Those commercial banks are supervised by Bank of Uganda. Then the other thing, the other sector that people don't know so much about, because this sector supervised by Bank of Uganda is 32 trillion Uganda shillings. Then you come on this side and there's a sector called Uganda Retirement Benefits Regulatory Authority. Now they are supervising about 18 trillion. Now what are they supervising? Pension and retirement benefit schemes, numbering about 60 in Uganda. And the employers numbering about 1,000 employers participating in that whole arena. Then you come to the insurance sector. Now the insurance sector is the standard, third party you're putting on your vehicle, life insurance and that whole kind of area supervised by the Insurance Regulatory Authority. Then you come to capital markets. And when you come to capital markets authority, the simplest way of understanding it is 1990s. There was a bank where Cairo Bank is located today. It was called Greenland Bank. Greenland Bank announced to the public we're selling shares. The public rushed and bought their shares. A few weeks later, Greenland Bank had collapsed. Massive outcry, 1990s. And people are saying, what happened? Bank of Uganda, why didn't you tell the Ugandan public that this bank was about to collapse? Bank of Uganda stands up and says, no, there's an authority that is now in place. That authority is responsible for the buying and selling of shares to the Ugandan public. It is called Capital Markets Authority. Anybody who wishes to sell shares to the Ugandan public goes to Capital Markets Authority. Why? To get a license. Now, once you've got a license, that license now mandates you to go to Uganda Securities Exchange and say, Ugandans, if you wish to buy our shares, come and buy the shares. Now, why do they call it capital markets? Because it's the market where companies go to raise capital. Another name for money is capital. If I want to raise money through selling shares, I go to the capital markets. I get a license and I go to the Uganda Securities Exchange and start selling my shares. As I sell a share, I sell a unit of ownership in my company, meaning that if I'm selling a unit of ownership, the money is in your pocket. If you give it to me, then I owe you something. I owe you ownership in the company, and by virtue of that, I'm giving you a dividend every time I make profit. Two, not only am I giving you a dividend every time I make profit, I'm also giving you the opportunity to buy that share at a low price and sell it at a higher price. Yeah.
Okay, now we talked about now buying shares. that's where many people actually get confused. The share, does it mandate you to be probably someone who goes to work in this company, or it just gives you, like you said, the authority to make decisions and influence the company? How far is a shareholder, as far as the company is concerned with the governance of the institution in which they have shares?
Okay, that's a very good question. What happens is, if I am interested in buying a share, number one, I must have an appreciation of which company do I want to be a shareholder in. The same as when you want to work somewhere. There are some places you say, yes, I want to work there. You get the idea. Other places you say, no, I don't want to work there. Same with the share. I want to own part of this company. Or I don't want to own part of this company. Now, let's pick MTN, for example. MTN is known to all of us. Everybody has a phone. At the end of the day, with that phone, I make my calls. You see, so every day I'm either making a call or I am sending mobile money. Now, that essentially means that I'm giving money to the company. You see, because all that is not for free. And I then need to stop and say, I like MTN. Do I want to work in MTN? Then I better look out for a job in MTN. Do I want to become a shareholder of MTN? Then I need to buy a share in MTN. That share does not mean I'm now an employee. It just means I'm a part owner of MTN. Exactly. So now I have a unit of ownership in MTN. Now, why am I looking for a unit of ownership in MTN? Two major reasons. I like the way MTN makes money. And now I am giving MTN money every day. Is there a way I can share in the profit of MTN? Now, what do I do therefore? I buy a share in MTN. Number two, I'm also saying, will I want to be a shareholder forever in MTN? Maybe, maybe not. You get the idea. Now, if it's maybe not, what am I then going to do? I'm going to say, can I get the share of MTN at a low price? In order for the time I want to sell, I can sell it at a higher price. Now, when I talk about low and high prices, those low prices may take long to come. You get the idea. Let's look at Uganda clays, for example. 1 year ago, to 18 months ago, Uganda clays was 8 Uganda shillings. Just 8 Uganda shillings. Meaning that if I had 8 Uganda shillings, if I had, because to buy a share, I just need to buy 100 shares. You get the idea. So if I had 800, I would buy Uganda clays. Now Uganda clays is 21 Uganda shillings. So the price has gone up. You get the idea. And it's gone up over a year. MTN came to the market at 200 Uganda shillings. And the price has gone down to 185. Why am I bringing that in? I'm bringing that in because when the price goes down, doesn't mean it's a bad company. The company actually, it may actually be a situation, excuse me, it may actually be a situation where people do not quite appreciate the company or appreciate the value in a company. Now, that's when they say that the share is appropriately valued. In what they're actually trying to tell you, it's time to buy because the price is low. You get the idea. So some people could be saying, oh, MTN was 200, now it's 185, I'm not going to buy. Others will be saying it's time to buy. Why? Because I want to buy at a low price to sell at a high price. Like Uganda clays, that price can change in 1 year. Other times it can take a long time to change. And that's why they say when you buy a share, always have a minimum outlook. Minimum, not maximum, minimum outlook of 5 years. So what you're putting into a share is what you call residue income. It's money you don't need for
day-to-day.
Yes, I don't need it for medicine, supermarket, petrol. No, this money is money I'm ready to put away for at least 5 years. Now, once I put it there, I'm now saying I trust the management of MTN. Mine is to attend an annual general meeting once a year. Apart from that, I have all the confidence that those who are inside MTN are going to ensure that we get the best management possible and grow this company. Once the company is grown, then maybe at that time my share price has moved from 185 to 1,800 or something like that, and then I will sell. Yeah, that's how shares work. So I don't enter the management of a company. I share in the profit of the company, and I buy at a low price to sell at a higher price. Yeah.
Yes, that was very interesting. Bring out the 5-year term, because many people actually in Uganda, we focus on short-term benefits.
Yes.
And usually that's what keeps people from investing in capital markets, because they feel like I have to wait for a long time. But now let's talk about the number of shares. Is someone restricted to buy a certain number of shares, or do companies float specified number of shares by the capital markets or Uganda Security Exchange, or it's actually open? I can say I'm buying 1 million shares, I'm buying 2 million shares, or I'm restricted to a certain number.
Okay, thank you very much for that question. What happens is, when I am selling shares to the public, I am in a situation as a company where I'm saying I know there's not one individual who can buy all these shares. In fact, when you look at the buying and selling of shares, 80% of the money that goes into buying and selling shares of companies actually come from retirement benefit schemes. Now, the biggest retirement benefit scheme in East Africa, not even in Uganda, is the National Social Security Fund of Uganda. You get the idea? Even the National Social Security Fund of Uganda will not be able to buy all the shares in a company. They will buy a portion in a company. So number one, what I'm saying is I make an assessment. Like now there are about 10 Ugandan companies on the stock exchange. The rest are from Kenya. Now I would look at the stock exchange and say, which companies do I like? I like MTN, I like Stanbic, I like Uganda Clays. Are we together? Now, what are we saying therefore? I will then target and say, let me look for the right price to buy Stanbic. Let me look for the right price to buy Uganda Clays. What the capital markets will then say is they know no one individual is going to be able to buy all the shares of a company, but buy a minimum of 100 shares. Yeah, buy a minimum of 100 shares. Now, when I buy a minimum of 100, what am I saying? I'm saying that I've gone in at a good price. I want this price to rise. I'll sell at a higher price. That's the basics. Two, when this company makes money, I'll no longer be saying, oh, look at how much money they made. I'll be saying that I am also a shareholder. I have 100 shares in MTN. I have 100 shares in Stanbic. I have 100 shares in Uganda Clays, and I can now sell those shares. That's how it works, yeah.
There's something that happened recently about the banks that were listed. They were told not to actually issue dividends by the central bank due to inflation and all these other things. In such cases, COVID-19.
Yes.
In such cases where companies don't give dividends, can shareholders actually put the companies to the test and say, you know what, when we were agreeing to buy shares from you, you promised dividends, so we have to get our dividends, or there's no way that the shareholders are protected against that?
Okay, that's a very good question. A very good question, I must say. Yeah. Now, when I go to the stock exchange to sell the shares, I'm not giving you a guarantee that the price will go up.
Oh, okay.
The price can go up, it can go
down.
Classic example, MTN. It came in at 200, it's now 185. Now, when it goes down, what happens? If I am in a get-rich-quick scheme, I will be thoroughly disappointed. But if I knew what I was doing when I was buying MTN, then I will know that in actual fact, if I get more money, I should buy more MTN shares so that I balance out at a good price. What am I trying to say here? When I purchase, I'm looking for an opportunity to say, number one, have I gone in at the right price? So that I can also sell at the right price. Number two, when they're dividing the profit, and they are not going to give me a guarantee that every year we will divide profit, or every year we'll give you this amount of money. What they're saying is, if you like us, buy us. If you like, if you think we're going to give good profit, buy our share so that you share in that profit. If the profit comes, well and good. If it doesn't come, well and good. Now, that takes me now to the banks. When you look at the banks and you say that, oh, this year they didn't give dividends. What am I going to do? Now, there are two categories of thoughts. One will say, me, I'll sell the share. And if I make a loss, I'll walk away. Because the bank didn't guarantee me they're going to give me an increase in shares or an increase in dividend. Two, somebody will say, because nobody thinks the banks are attractive, the share prices are going to come down. That doesn't mean that they're not making money. They're actually making money. So personally, I may look and I say, when I look at the banks on the stock exchange, which bank do I like the most? Maybe I'll pick Stanbic. And I'll say, when I look at Stanbic, these guys they have 27% market share. They have been consistent in their commitment to Uganda. And they're always making, their profitability is going up. I'll buy Stanbic. Why? The price is now going
down.
It's time to
buy.
I missed the opportunity 2 years ago, but now because the price is going down, let me buy. Why is the price going down? Because they're not giving dividends. Why? My outlook is 5 years. I'll wait. I may miss a dividend in the first 2 years, but in 3, 4, 5 years, it may compensate for all the years I missed. That's the way shares work.
Someone may ask as well, how do share prices go up and down? Because you said it's not an indication that the company is doing bad.
Yes.
But let's take an example. The company is cross-listed from Kenya.
Yes.
Over the last few weeks, all companies have, okay, well, not all, but most of the companies have been going down in terms of share price.
Yes.
And of course, when you ask, they'll tell you because of the elections, I don't know what, they give all these excuses. But that doesn't mean that the companies are closing or they're running bankrupt or something. Now, what are the other factors that come into play that affect the share price, either going down or up?
Okay. Let me give you, let's pick the dividend issue. The dividend factor is leading to the drop in the shares of banks. Now that it can be because some people could be saying, but if I buy a share, I want profit every year. Now that you're not giving me profit every year, let me go and buy a bank that's giving me profit every year. Two, another way of looking at it is Uganda Clays gives a classic case study of why share prices go up and share prices go down. Uganda Clays announced, it was actually the first clay company to sell shares to the Ugandan public. The share price rose from 4,000 to 250,000
per share.
Per share. Wow. You get the idea. Now I must qualify that because when the price rises, what actually happens is, let's say it goes from 1,000 to 10,000. The board of directors sits down and says, look, the share price is being perceived as expensive. It has moved from 1,000 to 10,000. Let us now do a share split. Instead of having one share at 1,000, you now have 10 shares. Sorry, instead of having one share at 10,000, you now have 10 shares at 1,000. Are we together? That's a share split. So Uganda Clays went through different share splits. So I'm just assuming that the share price didn't go through a share split. So
meaning people who had already bought at 250.
Yeah.
Maybe probably we divide it, for example, by 25 and say now you have, instead of one share, you have 25 shares.
Exactly.
But you've already bought at the other
price.
Exactly,
yes. Oh, okay. Very good. Yes, yeah. So I'm about to give you an A+.
Thank you.
Yeah, very good, yeah. Excellent example. Yeah, so what happens is Uganda Clays rose. Now, at the end of the day, what's happening? Uganda Clays is saying, we are making so many Kajansi tiles. People like these kind of clay tiles. They're using them on their houses. What else can we do? Can we expand? And they said, yes, expand. And what did they do? They moved to Mbale, a place called Kamunkoli, and they opened a factory there.
So they raised a lot of capital.
Now, that's a good one.
Yes,
that's a good one.
Like they needed to expand.
Yes. Now, they raised capital by borrowing.
after getting capital from the public.
Yes.
Now they wanted to raise more.
Yes.
But through borrowing.
Through borrowing.
Okay.
Yes. So they borrowed. They went Standard Chartered, Stanbic, and they gave them money. So they go to Kamunkoli, and their feasibility study said, we are going to Mbale because Sudanese use that route to go to South Sudan. They'll pass by our factory, buy, and continue on their journey, because South Sudan was coming back at that time. Now, what happens as soon as they have done that? South Sudan goes to war. So people don't buy during war. Two, the Kenyan market is going to do what? In Western Kenya, they don't have a Uganda clays. Now we're going to export to Western Kenya. And the moment you talk of exports, any Ugandan is going to get excited. And you know, everybody was saying, now more exports for Uganda. As soon as they opened in Eastern Uganda, Kenya clays opened in Western Kenya.
Yes.
You're asking why share prices go up and down. So evidently, Uganda clays has borrowed. They are in Eastern Uganda. Every market they are trying is closing.
Yes.
Are we together? So they default to Ugandans and go to Ugandans and say, guys, buy Uganda clays. So Ugandans, being who they are, go and look at this product and say, but this one doesn't look like the one we are buying in Kajansi. There was a black suit from the machines coming onto the clays. Let's go to Kajansi and buy Uganda clays. What's happening? You can't sell. No revenue, profit goes down. If profit goes down, the share prices stay up, they go down. You get the idea. East Africa's biggest retirement benefit scheme, NSSF comes in and says, we'll rescue you. Here is the money. Take it, pay the banks. After that, give us interest on what we have given you for 5 years. After that, this becomes shares in the company. So they rescued Uganda clays, and Uganda clays is now bouncing back. Share price is beginning to go up. Yeah. So why have they gone up? Better management. Markets are continuing to open up. Ugandans still have faith in Uganda clays. Better machinery coming in. Share prices now start rising after going down. So I hope that tells you why share prices go up and they go down. And a testimony to that, when I buy a share, have a minimum outlook of 5 years.
Thank you. We are still with Mr. Martin Owini, and we're having a very interesting conversation here on capital markets. Now, we're going to go into a short break, but when we return, we'll look at the other side of the capital markets, something that has become very famous today and popular, the collective investment scheme, and how it made a 17.4% growth, and all this stuff. What is an investment scheme? What is unit trust and all that? Coming up later after the break. Don't go away.